of investors when you start raising funds. I was in touch with Aishwarya and Gautam to design the topic, and we felt was the term sheet or the the elements of the term sheet, rather the certain key words that you would find in the term sheet would be of importance to you because they are quite unique, and if you face them for the first time, you may not be able to understand its full gravity. And with knowledge of these terms, you'd be able to discuss with investors or their legal team with a lot more confidence. So let's begin. What I've tried to do in the session also is to give you actual screenshots of term sheets that we have worked on. These are live documents. Of course, I've redacted them so that the name of the company, the name of the investor is not disclosed, but the language that you would see on the screen, this is how a document is going to look. And the idea of sharing these screenshots is so that you familiarize yourselves with the kind of documents that may come your way once you start raising funds. So the first question is, what is the term sheet? What purpose does it serve? And how important is it to a startup? Now, the term sheet, think of it as an MOU, but within a legal framework. So it is the understanding between the startup and the prospective investor. And I would like to highlight the word prospective investor because by signing a term sheet, it does not mean that the prospective investor has already put money in your company or has agreed to put money in the company. All that it does is establish the terms or establish the framework within which the investor would be willing to invest in the company, provided, of course, you tick certain other boxes. Now, those other boxes would be, say, financial due diligence, legal due diligence, secretarial due diligence, and getting these clearances that you need from the investors team, and then the actual investment happens. The documents that follow the term sheet are called definitive documents, and these are shareholders agreements. They are sometimes split into two parts: shareholders agreements (SHA) and share subscription agreement (SSA). But the term sheet is the first document that you would see, and usually term sheets are critical because using the term sheet from one investor, you could elicit interest from other investors. So the term sheet is a document that usually investors in a round ask. And if you start raising funds and you approach a particular investor, they might ask you a question: have you received a term sheet from any other investor? And this is the importance of the term sheet. If you get a term sheet in hand, it means people are serious enough that they're willing to share terms with you, they're willing to share the principles on the basis of which they'll be investing in you. So it is a step closer to investment. So you can think of it as a validation of the discussions that you have been having with the investors. Now, the term sheet typically looks like this. This is the first screen. I have taken parts of the term sheet, and you'd see that in subsequent slides. And what it does is it states two things. One, that it is confidential. If you have to share the term sheet with anybody else, you need the specific approval clearance of the prospective investor from whom you've received this document. And it is also non-binding. So it is very interesting that the term sheet uses the word, it is only binding, enforceable to the extent of certain terms that are called out. Otherwise, it is a non-binding document, meaning you cannot force the investor or the prospective investor to put money in the company just because they have signed the term sheet. Like I said, the term sheet will have a qualification at the end saying that we would be willing to consider investment in the company provided you clear certain other checkpoints. So the term sheet is the first step towards investment, right? That is the foundation on the basis of which we'll build this presentation. So what I've tried to do in the presentation is I'll go back to some of the basics. I remember our first conversation where we looked at private limited company structures, we looked at certain instruments. I'd want to quickly touch upon those 2 points because they become important to understand the rest of the presentation. And this is the core of the presentation, which is the term sheet, right? I have tried to break the rights, I've tried to break down the duties of the company, the investor rights into 4 brackets. The first one is instrument specific rights, where we look at conversion ratios. And these could be full conversion, or these could be and the weighted average conversion. So we look at both of them. We will look at board and governance rights, and this is board seats that investor asks for. There's something called reserve matters or affirmative voting rights. There's something called quorum, which you need to know. And all of this is part of the governance rights that investors have. How do the investors deal with founders? What is the relationship with founders? There are terms like lock-in, ROFO, ROFR, tag, reps, warranties, event of defaults, and personal indemnity. So we'll cover these topics. And exit rights, primary liquidation preference, they call that. And nowadays, people tend to shorten longer words in the startup world. So they call it liq pref, and that's nothing but liquidation preference, drag rights. There's something called minimum IRR and buyback. So broadly, your term sheet could be split and classified into one of these heads. You rarely find the clause which would be out of this group. Of course, I'm not, there could be other clauses too, but the core of the term sheet could be summarized within these 4 brackets. So let's begin by understanding the corporate structure and instruments. Let's start with this. So the first one is the business structure. And if you remember from our first conversation, there are 3 kinds of structures, or multi-person structures. So partnership firm, LLP, and company. Partnership firm, of course, has the restriction of unlimited liability. It is not viable. It is not a good investment vehicle. You have limited liability partnership, but the problem with LLPs is that you cannot define capital structure clearly. So companies are ideal structures for making investments, and startups are usually structured as private limited companies. Most of you, if you have already set up your business, you would be set up as a private limited company for these reasons. Now, the main features of a private limited company, and which is the reason why you draft a term sheet, is to cover these aspects, right? One, that it is an artificial person, it is run by a charter, which is the MOA AOA. And when the investor gets into an agreement with the company, the shareholders agreement, it is this charter document that is amended. So you'd see an amendment in the articles of association to incorporate the terms that the investor wants you to wants you to run the company by. And because the company is defined by its charter, and so you need those terms within the AOA. So term sheet will lead to SHA. SHA will lead to a modification of the AOA. You have limited liability, but I have seen agreements overcome limited liability and make the promoters or make the founders personally liable. It used to happen a lot in the 2010s, but the cases have drastically reduced. You do not see personal liability anymore. Meaning personal liability is a way by which the investor through a contract can overcome the limitation of liability that the Companies Act provides. There is segregation of ownership and management. We will look at that shortly. Again, it is an element that the term sheet looks at and finds ways by which you can control the ownership or management of the company. The ownership of a company is defined by units. These are called shares. We will look at different kinds of shares and how the term sheet would define these conversion rights or redemption rights. You have voting rights. Voting rights are available to both shareholders as well as board that is the directors. Again, term sheets will have specific reference to voting. And there are restrictions for the public to invest and for existing shareholders to transfer shares. And which is why the term private limited company. You cannot allow public to invest, and the transfer of shares between investors or between shareholders is restricted. Again, term sheets will find a way to overcome this limitation. And that is how the term sheet and the SHA will relate, or there is an interplay of the term sheet with the SHA and then eventually the articles. So you'd see that we have found a way to overcome some of the restrictions that the Companies Act places on private limited companies. And it is it's quite ingenious. It's a smart way by which we are able to overcome these limitations and make sure that the investors' rights are also protected. As far as the 2 groups are concerned, like I mentioned, shareholders and board of directors, right? Now, if you look at shareholders, they own the company, and any profit that the company makes belongs to the shareholders. Now, shareholders take decisions by way of meetings. There are 2 kinds of resolutions that they pass. It's called the ordinary resolution, where you have a 50% major 50% approval that you need to pass an ordinary resolution, or you have a special resolution. For a special resolution, you need the approval of at least 75% of the people present in a shareholders meeting. We have different kinds of rights for different kinds of shareholders. You can issue shares with differential voting rights, differential dividend rights. Normally, startups do not complicate their capital tables by issuing these kind of shares, but as the startup matures, you may find shares with differential rights. You can have a maximum of 200 shareholders in a company. And as far as board of directors are concerned, they manage the company. So we think of them as custodians. These are people who run the day-to-day operations of the company. Uh, the board of directors are appointed by the shareholders. So they owe their allegiance to the shareholders. The shareholders have the right to not just appoint, but also remove board of directors if they are not happy with the way the company is being run. And board of directors have a simple majority vote. There is no ordinary or special resolution. And the decision making in a board meeting happens by way of show of hands. In the case of shareholders, you will have show of hands to start with, but then you can always change that into the vote share, meaning number of shares that are owned by an individual. And that is the basic difference between these two. You can have a maximum of 15 directors in a board, but it is mandatory that at least one of them should be a resident of India. Let us look at instruments. Let us look at three kinds of instruments. I'd look at equity, preference, and options. Let us first look at equity. Equity are called ordinary shares, and because this is the most fundamental kind of instrument that a company can issue, all decisions that are taken by a company are taken by these equity shareholders because they are the primary owners of the company. The equity shareholders are entitled to dividend, which is the share of profit, but unfortunately, they are last in line to receive any share in liquidation proceeds if the company is shut down. On the other hand, if you see preference shares, these are also called preferred stocks. The reason they are called preference shares is because they have preferential rights over equity shares to receive profits or liquidation proceeds. So they are first in the line, equity shareholders come next. Preference shareholders, the dividend can be defined by way of a coupon rate. So similar to a fixed deposit for that matter, right? You can have a 6% or a 7% preference share. And this is the rate of dividend that they would receive. Preference shares come in variations, so you can have a compulsorily convertible preference share, which is compulsorily convertible to equity. You can have an optionally convertible preference share, which can be optionally converted to equity or redeemed. And we, of course, have the redeemable preference share. So three heads, CCPS, OCPS, RCPS. The final instrument that I'd want to cover is option. Options come in two varieties: ESOPs, which are given to employees, employee stock options; warrants. These warrants are offered to people who are not employees. They could be advisors, or they could be people from whom the company can benefit. And an option holder has the right to purchase shares. There's no obligation. The option holder may choose not to exercise the right. But there are two considerations that are paid. One is the option price itself, which is the price to buy the option. And you then have the exercise price, which is the right to buy the share. So I want to pause here for a few minutes to see if you have any questions before I start getting into the topic itself.
Hi, myself Madhu. Hello.
Yes, Madhu, please.
Uh, yeah, I'm a part of the LLP. Can't we expect the shares from our investment from the LLP? Is it not allowed?
Um, it is uh, it is allowed. You can get an investor into an LLP, but the problem with the LLP structures is you cannot define a capital structure.
Yeah,
The
you're
when you say I will give you say 5% as an investor, I'll give you 5% of my company. In a private limited company, you can clearly define what that 5% is because you can say 5% means X number of shares, and those shares can also be issued at a premium. The problem with an LLP is it is very hard to define this 5%, and you need to amend your LLP deed. Now, 5% in capital may not necessarily mean 5% in profits, so it gets a bit tricky. And the concept of issuing a stake in an LLP at a premium involves something called a fluctuating capital account. So you have a fixed capital account, you have a fluctuating capital account, and it gets a bit complicated. The matter gets even worse when you look at taxation because in the case of LLPs, capital gains tax is now supposed to be paid by the LLP and not the individual. So not a very efficient structure if you have to raise funds.
okay. Then what is the suggestion? We are having one LLP. Is it better to convert it to
Yes.
company? Okay. I mean, amending the existing one and starting a new one, kind of, or converting. What would be the
If you have built a substantial IP, if you have built a product, and if you have a history within your LLP, I would recommend conversion. But if you're in the early days, you just shut down the LLP and start a new one.
okay? Great. Thank you. Thank you very much.
Sure. There are two more questions, Anupama Bhatt and Shruti Rao. Do ESOPs get dividends too, and difference between CCD and CCP? I'll quickly take these two before I jump back into the subject. So ESOP holders will not get any dividends because ESOP is just a right to a share. When ESOPs get converted to equity shares, then the recipient of the ESOP, which is the employee, becomes a shareholder of the company and would be receiving dividends too. Now, difference between CCD and CCP. CCD is compulsorily convertible debenture. CCP is compulsorily convertible preference shares. CCD is a debt. Now, CCD and CCP, given the C and C that you see there, they are both compulsorily convertible. So practically, there's not much difference. The difference lies in the way these instruments are issued under Companies Act. I think CCDs, you necessarily have to do a private placement. You cannot do rights issue. CCPS, you have the option of doing rights issue too. So a private limited company cannot issue a debenture unless it is hypothecated. Either you see, you can issue a redeemable debenture only if you have assets against which you can pledge that debenture. If you do not have any assets, you have to issue a compulsorily convertible debenture. So that is the fundamental difference. It is better that you issue CCPS than CCDs because CCPS sits under capital, CCD sits under debt. Prashant, you'll have to hold. I'll hold this question. Let me finish a couple of more slides and I'll come back to your question about CCPS. Right? So let me quickly get back into instrument specific rights. We look at conversion. We look at two kinds of conversion, full ratchet anti-dilution and weighted average anti-dilution. Now, the meaning of conversion, like we've looked at in the previous slide, we look at two instruments, CCPS, OCPS. Now, these preference shares or debentures get converted to equity shares, and the conversion is based on certain triggers. Now, the trigger could be the time based. For example, after the end of 3 years, I will convert the CCPS to equity shares, or it could be based on an event. For example, the next fundraise that the startup engages in, I'll convert my CCPS into equity shares. There is a way by which you can calculate the number of equity shares you get for every preference share that the investor owns. Either it can be a ratio which says that for every one preference share, you would get one equity share, or in my example, 1:1.2, meaning 1.2 equity shares for every one CCPS, or the conversion could be based on a price. Now, the conversion price itself could be determined in the next investment round. So, for example, you've raised investments in October 2024. Your next investment could be in, say, March 2026. The price in March 2026 with a certain discount could be the conversion price for the CCPS. Why discount? The reason the concept of discount has evolved is because the CCPS investor has trusted the company in the early days. So naturally, the price at which the CCPS holder would get equity shares cannot be the same price that somebody would get at a later point in time because the CCPS holder is taking the first risk, which is why the CCPS holder gets a discount. I want to share two screenshots. Again, these are from actual term sheets. If you see the first screenshot, it says the CCPS will convert at a 1:1 discount to ordinary equity shares. And the second extract that you'd see would say company will issue convertible notes with a discount, but the discount is again time-based. So if the company raises funds within the first year, 30% discount, second year 40%, post second year 50%. Now, naturally going by what I've explained, as the time lapses and the startup needs more and more time to raise capital, it means the startup itself is becoming more riskier. And the CCPS holder should therefore be compensated for the risk and get more equity shares in return, which is why the discount percentage goes up. Now, the two matters that I want to look at here is the conversion from the point of view of anti-dilution. To understand anti-dilution, you need to understand what dilution is. Dilution basically is reduction of your equity. When I say your could be any existing shareholder. It could be the founder, it could be an existing investor. Now, when a new investor comes on board, naturally the percentage of ownership in the company will reduce because 100% will then be divided into n plus 1 because that plus 1 has now entered the cap table. So dilution happens when you have an incoming investor. Anti-dilution is the opposite. But now the question is, can there ever be anti-dilution? Now, logically, you can never have anti-dilution, right? Because whenever a person comes in, everybody naturally has to dilute. But anti-dilution basically means that if the investor has received shares at a particular price, but the next round of investment is happening at a price that is lower, then naturally the investor who's come in first ends up losing, because I have paid a higher price to the company and I expected the company to progress, and that's the promise made by the founder to me. But the company has not done well, which is why the price has dropped. And as the price has dropped, I have ended up losing, meaning I have ended up giving up a higher percentage in the company to the incoming investor. So the first investor will have to protect itself, and which is why you have the concept of anti-dilution. Now you would see a clause here. I am going to share this presentation with you. It's quite a bulky clause, but what it says is that if the company has issued shares at a price lower than the price paid by the investor, then the investor would be entitled to receive additional shares. And how do they receive additional shares? The calculation is done as per this term sheet. It is done by using something called broad-based weighted average conversion formula. I will explain what this is. And you'd see this broad-based weighted average anti-dilution formula is becoming exceedingly popular. There are two conversion formulas. The first is called full ratchet. The second one is a broad-based weighted average, which you'd see in the extract above. Full ratchet basically says, I will take whatever is the lowest conversion, whatever is the lowest price in the subsequent round, and I will use that as the conversion price. Now, naturally, this is not good for the founders because there may be events that are out of their control, and the if the investor is going to convert at the lowest price, down round price, then the person who loses in the transaction is the founder. Because if you look at the cap table 100%, if you have to give extra percentage to the investor, naturally the founder has to give that extra percentage from his pocket. So the founder loses. And what companies and investors started seeing is that as the founder started losing more and more percentage and their ownership dropped, they started losing interest in running the company, because then there's no difference between a founder and an employee. And the concept of broad-based weighted average evolved. Now, broad-based weighted average looks at a formula. It looks complicated, but it's quite simple. What broad-based weighted average does is it looks at two price points: the price point at which the investor had come in first, and the price at which the next round's investments happened. And what they try and do is apply this formula to find out what is the midpoint. When you apply a broad-based weighted average formula, the number of shares or the percentage that the founder has to give up drops. And so this was considered to be more favorable. So the long story short, in your term sheets, if you see a full ratchet conversion, you can go back to your investor and say it's not acceptable to you because it is no longer industry standard. 99% of the cases you're going to see broad-based weighted average on your term sheets. And this is exactly what broad-based weighted average means. When I send the presentation to you, Aishwarya, please remind me. I will add a few examples and send it to you so that understanding this concept becomes a bit more easier. Okay.
Yes, sir.
Um, let us look at a couple of more points from the point of view of governance, which is board seat and reserve matters and quorum. Like I mentioned, a private limited company can have a maximum of 15 directors. And if you'd see a single company, that is 15 directors in a single company. But a person can become a director in 20 companies. And this normally happens with investors because they'll have their representatives sitting in multiple companies. Now, the investor would ask you certain rights as startup holders. There are two rights that the investor would ask you. First is the board seat. The investor would say that because I'm investing money in the company, I would want to have a say in the way the company is run. And the investor would say, I want a board seat, which means that in addition to the founders and the existing directors, the investor also would become a board member. Now, when the investor becomes a board member, the voting happens and the investor's right is, or the investor's opinion naturally has to be considered because now they're part of the board. But what started happening was that if you look at some of our tax laws, if you look at company law, there is a lot of responsibility that is placed on the director. If the company defaults, then the directors are personally liable. And this made the position of the investor risky because the investor said, I am not involved in day-to-day operations. I'm not intimately connected to the company as founders are, but I am responsible now because in case of a default, the government could come and ask me questions. So I do not want a board seat. So the concept of an observer seat evolved. Now, Companies Act permits a company to invite a professional into the board meeting if the directors feel it is necessary. So the investors have used that philosophy and have introduced a concept called observer seat, where the investor's representative as an observer will be part of the board meeting. The investor knows everything that's happening, but they cannot vote. So they are silent unless they are asked to speak by the board of directors. So you'll see two more excerpts here. The first one says the investor will have the right to nominate one non-voting observer, which is what we covered. The next excerpt says that the investor will have the right to nominate two directors. In addition, the investor will have the right to appoint one board observer. Now, if you come across any such term on your term sheet, please go back to the investor and say that this is excessive. Either accept a board seat or accept an observer seat. Ideally limited to observer seat because it gives you as founders a lot of flexibility to run the company. Of course, you will be transparent with your investors. You're going to report everything that needs to be done. And there are certain additional rights, which we'll see, reserve matter rights and quorum, which you'll see next, where the investor is able to protect itself. So having more directors on the board of director on the board will only complicate matters. It make decision making extremely slow, and we have seen companies struggle if you have a lot of directors. Keep your board extremely lean, and if need be, offer the observer seat to the investor. There's something called reserve matter, and like I mentioned, decision making in the company, two groups. One, the shareholder group. Shareholder, you have ordinary 50% resolution, special, which is 75% resolution. But the investor would also want to have a say in matters that are outside the ambit of what company law provides, right? Now, that is where the concept of reserve matters evolved. Reserve matters of affirmative voting rights is a list of matters where the company needs the specific approval of the investor. Now, there could be certain decisions that relate to the structural alteration of the company. For example, if the company wants to allot more shares to an incoming investor, company wants to amend the articles of association, company wants to add a new board member. These are structural alterations. Second are economic rights. If the company is taking a loan, company is selling away certain assets, company is selling away a line of business, these are economic decisions which impact the return to the investor. So in these two groups, the investor would say, I want the company to take my specific approval before deciding on that matter. It is extremely important that you document the approval or the dissent of the investor. Now, we have seen startups taking reserve matters clause lightly. They do not take the investor's approval, nor do they inform the investor. And when things go south, the investor uses that and is also able to petition to NCLT, is able to send notices to the startup saying you have not complied with the shareholders agreement. So please treat reserve matters with utmost importance. Here's an actual term sheet. This is a screenshot. And if you see, this is how a list would look: amendment to AOA, amendment to ESOP policy, any subsidiary that the company wish to create, incurring any indebtedness or basically loans that the company takes. All of these are reserve matter rights for which you need a specific approval from the investor. One more slide before we take pause for questions. As far as quorum is concerned, quorum means the minimum number of people who have to be present for a valid meeting. Now you have a quorum for board meeting, you have a quorum for shareholders meeting. For board meeting, the quorum is 1/3 of the total strength, which means if you have, say, 6 directors, at least 2 of them should be present. Shareholders meetings, at least 2 members have to be present unless your articles prescribe a higher limit. What happens if the quorum is not present? Then you're forced to adjourn the meeting and call for a new meeting. If a decision has been taken in a board meeting or a shareholders meeting where the quorum is not present, then that meeting is invalid. We call that void ab initio. And any decision which has been taken in that meeting cannot be enforced, has no significance. The rights that are available to an investor, and what you'll see on a term sheet, which say that unless the investor is present, there is no quorum. So this is a way by which the investor is able to enforce his presence in the meeting. And it is very similar to a reserve matter rights, because the investor once the investor is present in the board meeting or the shareholders meeting, the investor would be able to at least express their thoughts or participate in the decision making process. The absence of the investor could make the meeting void ab initio, which means that the founders or you as promoters would not be able to take any decisions. Here are certain excerpts. again, you would see that the quorum of a shareholders meeting is possible only if the directors are present or the investors are present. Again, I want to stress that these are actual extracts. So this is how a real term sheet would look. And some of these clauses you could familiarize yourselves so that when you get a term sheet, you'd be able to relate to whatever we are discussing today. Okay, I'll pause to take questions. Let me take Prashant's question. Now, compulsorily, when does the okay, I didn't understand the question, Prashant. If you can please type that again. And also if there are any other questions, please.
Yeah, I think that is answered, Pavan. I just wanted to ask, when does this compulsory thing become actually equity for an investor?
Okay. Let me pause for a minute or so to see if there are any other questions.
Any questions, please unmute and ask, or you can put a message in the chat box.
Okay, let us proceed. So in this section, we look at lock-in, reverse vesting. We look at ROFO, ROFR, and tag-along rights and representations and warranties. Now, some of these clauses could get a bit technical. So I will explain the basic concepts. Take this presentation with you, go through it again, and if you have questions, you can always write to me. So the first one is what we call lock-in and reverse vesting. And to understand lock-in reverse vesting, you need to understand the relationship between the investor and the founder. See, in the startup, the company is nothing but the founder. Meaning, the reason why investors put money in the company is because in the early days, at least, you have a good founding team who are pursuing a good idea. So they're both important. If you have a team that's not I'd say solid when it comes to its work or ethics, then even with a good idea, the investor is not going to put in money, right? So the relationship with the founder is extremely important. If the founder itself were to exit the company, then there's no company. And which is why the founder becomes a very important asset to the investor. And the investor, through the term sheet, through the SHA, would want to bring in clauses that can restrict the mobility of this investor, or sorry, restrict the mobility of this founder outside the company, meaning they would want to lock in the founder within the company. And which is why the concept of lock in and reverse vesting has evolved. Lock in basically means the minimum number of years that the founder will have to spend within the company before the founder is able to transfer shares to a third party or before an exit event, which means that after the founder has gone to the investor, has sold the idea to the investor likes the idea, he decides to invest, puts money in the bank account, and the next day the founder cannot pack bags and leave saying that I'm done. Because then the investor would naturally ask, why did you bring me into the picture, right, if you were to leave? So the lock-in clause says that the founder cannot exit the company till such time the investor is in the company. So the first right to exit the company is of the investor. They should be able to sell their shares first, and only thereafter would the founder be able to sell its shares. So the concept of lock-in means that the founder cannot transfer shares and get cash or get economic benefits in return. And the concept of reverse vesting has evolved from there, saying, now when we say lock-in, and let us assume that an agreement says, let us take this example, right? This agreement says lock-in for 3 years. The way reverse vesting works is that you will not have to work for all 3 years, because there could be exceptional cases where the founders may have had to exit, and we have seen several of them in our careers. So what reverse vesting says is that for every year of the 3 years that you work, we will release one third, one third, one third of your ownership. Now, in the second year, at the end of the second year, 2/3 or 67% of the shares held by the founder would be released. For some unfortunate situation, if the founder will have to exit the company, the founder can hold 2/3 of the own shares, and 1/3, which is unvested, is released. So when you say the reverse vesting, it works very similar to ESOPs. ESOPs, you have a concept of forward vesting, meaning only when the employee spends sufficient time in the company, would the employee be entitled to receive shares. In the case of reverse vesting, the founder already has shares, so there's no question of giving more shares. But the founder's shares gets released, and that is how you differentiate between ESOPs and reverse vesting. Now, in the case of vested shares, the company can either buy it back or the investor can buy the shares from the founder, and those shares are usually bought at fair value, which is market value. Unvested shares are usually bought at face value, meaning the founder does not get any benefit by exiting the company. So two clauses. The first one I've covered, which is 3-year vesting. The second one, you'll see they use the word, right? Reversed, reserved or unvested shares. And this is these are shares for which the founder has not spent time with the startup, right? So here, this is the concept of lock-in and reverse vesting. Let us look at ROFO and ROFR. ROFO stands for right of first offer. ROFR stands for right of first refusal. Let us look at the first clause, right of first. The way ROFO and ROFR work, they regulate the exit that the founder could get. It regulates the price that the founder would get on an exit. So if you look at the first clause, which is ROFO, as the word suggests, right of first offer, means if the founder wants to exit the company after the lock-in period, the founder will have to first make an offer to the existing shareholders, primarily the investor. And if the offer that the founder receives from the investor is not acceptable, then the founder can go to the open market and search for better offers. So the first offer will have to come from the investor. Right of first refusal works the other way. After the lock-in period is complete, the founder can go to the open market and find out terms, price at which people are willing to buy these shares, and will then have to come back to the investor with that offer, and the investor has the right of refusal. If the investor says, I'm going to match these terms, match the price, then the founder is forced to sell the shares to the investor. If the investor is not able to match or better these terms, then the founder has the right to sell the shares to a third party. Now you'd see the difference between these two is in discovery of price or discovery of terms. In the case of ROFO, the responsibility to determine the price is on the investor. In the case of ROFR, the discovery process is to be taken up by the founder. Naturally, the investor will not want to take up more work. So you would see ROFR being used in agreements more often than ROFO. Here are two excerpts. Let me go back. Yes, so here's an excerpt from a term sheet that you'd see. Now, in this term sheet, they have used ROFR, naturally, because they would want the founder to go to the open market and find out what the terms are, and then come and offer the same terms to the investor. Tag along. Now, tag along, the concept says that after the lock-in period is complete and the founder is selling shares. Now, look at the transition. We looked at lock-in, we looked at vesting. Now, after the lock-in period and vesting is complete, the founder may want to sell shares. When the founder wants to sell shares, you have a concept like ROFO and ROFR, which says who will determine the price, who will determine the terms of the transfer. ROFO says the investor will determine it. ROFR says the founder will find out what the price is. Now, after this step is complete, the sale actually happens. And at the time of the sale is when you have the concept of tag along. Tag along says that the investor will, like the word says, tag along the founder to sell the shares. So if the founder is selling, say, 10% of its ownership in the company, say the founder owns 15% of the company, founder wants to dispose 1.5%, 10% of the ownership. Tag along clause says that the investor will also have a similar right to transfer 10% of its ownership. So the tag along says that if the founder is getting an exit and converting shares to cash, investor also should have the right to convert shares to cash, because the whole purpose of the investor coming into the company is to make financial gains. You cannot have a case where the founder is making financial gains and the investor is just sitting on the cap table, right? So you have a concept of tag along which says that the founder and the investor would be tagged together to transfer these shares. Tag along has certain nuances. The tag along right may say that the investor may either proportionately sell shares to the founder, in my example 10%, or the founder may seek, or the investor may seek priority over the founder. Meaning, if the third party wants to buy a limited number of shares, the third party will have to first buy my shares as the investor. And if there is any space left or any appetite left, then they can buy the founder shares. So even there, naturally, the investor would want a better term than the founder. Here's how a typical document looks. I'd look at this section quickly before we pause. Representations and warranties. Now, representations and warranties, please give me a minute. I'll have to charge my laptop. Give me 1 second. Yes, sorry for that. So representations and warranties is usually a clause that's not given enough attention. But in my opinion, it's one of the most important clauses or the most important clause in the term sheet. And I'll tell you why. Representations warranties are promises that are made by the founders to the incoming investor. Now, these promises can fall under different brackets. So you'd see these categories: organization, capital, director, financial statements. Now, what does this mean? Now, these are commitments that are being made by the founder to the investor. When the founder is saying, I'm running a clean company, please come and invest. I have no pending cases, please come and invest. I have not received any notice from any tax authority or any regulatory authority, please come and invest. My financial statements are 100% correct. They are true in all senses. So please come and invest. I do not have any disputes within the group of directors or founders. They are all aligned to the company's vision. Please come and invest. Now you would see that this please come and invest basically is a request that the founder is making to the investor based on certain commitments. Now those commitments are what we call representations and warranties. Representations are saying that here's a statement of fact that I have received no notices or no claims from any government authority, or there are no customer liabilities on my company. And this is a statement that the company is making. And the company is giving an assurance to the investor saying, please come and invest in my company. If these statements are false, then the matter can blow up into what we call an event of a default, meaning the founders have fraudulently raised money. And in the case of an event of default, the investor can also extend the liability to the personal liabilities, or the indemnity that the investor could seek would be from the personal assets of the founders, because it is a falsified commitment. And which is why I urge startups to please read representations and warranties. Normally it runs into 4-5 pages in a document, but every word there is important, because if you make any mistake there, or if you have not disclosed the facts to the investor can ignore the Companies Act limitation of liability, like I mentioned in the beginning of my presentation, and can enforce personal indemnity from each of the founders. So it's an extremely important clause. Also, the document uses the word jointly and severally, which means that each of the founders would be responsible, and they are individually responsible to the investor. A limitation of liability will not be applicable in case of any fraudulent claim or any incorrect claim made by the company. So let us look at exit rights. We have two clauses, liquidation preference, IRR, and drag along. Let me look at these two quickly before I pause for questions. That should be the end of our session, because I know we have only a few more minutes left. Liquidation preference is a right given to the investor to at least receive the capital back in case the company enters into liquidation, or the company enters into a major event, which could be merger, it could be a sale of assets, it could be the exit of key management personnel. Now, these are events which could basically mean the company shutting down. When the company is shutting down, the investor would say, at least return the capital that I've introduced so that my capital is safeguarded. It is like putting money into a bank deposit of sorts. I need to get back my capital. Do not pay any returns, at least pay back my capital. Sometimes investors say that I want my capital plus certain returns, and those returns are called IRR. IRR basically is a rate of return that you would get on top of the investment. And this is, think of it as interest that you get on fixed deposits, but naturally much higher than that interest. Now, IRR is applied on the capital that the investor has introduced in the company. For example, say the company has received a crore of capital from the investor. Liquidation preference clause could say, I want my crore back plus a return of 25% since the time I invested. So this is typically how a liquidation preference clause would read. In this term sheet, the investor is saying, I need money equal to 100% of the subscription amount, meaning I do not need any money on top of what I've invested. So this is a kind investor, and they're saying, I'll be happy as long as I get my liquidation preference capital. I'll be happy if I get my capital back. There's another concept called drag. To understand drag, we have to understand why do people invest money in startups? They invest money for returns. Now, somebody cannot wait for infinite number of years to get returns. They cannot wait for 10, 15 years because they would be able to make much better money with lesser risk in even general markets, right? Why would they want to take the risk of investing in a startup? So there is an outer limit, or there's a timeline by when they would want to get their returns back. And that is where drag comes into the picture. What normally happens is, again, a commitment is made by the founder saying that you invest money in my company, and in the next 5 years, you'll be able to see X number of returns. And that 5 years is the time limit that we see. Typically, the exit is between 5 to 7 years. Means that the investor would say, either find a new investor who can buy my shares or go public. Take the company public, let new investors from the public come in, and I get an exit. Ultimately, I need an exit. Drag along says that in case the founders are unable to get an exit, are unable to return money to the investor will have the right to drag the company and sell it to anybody that the investor wants to. Now, that anybody could also be a competitor of the company, because it is the option of last resort. As the company is unable to provide any return to the founder, the investor says, I cannot wait any longer. I will take your company, I will sell it to somebody who's giving me the best price I can get. And you are forced to sell your company to the investor that, or rather to the buyer that the investor identifies. And this is typically how a drag along clause looks. So you'd see that even after 5 years, if the investor is not provided an exit, then the investor will have the right to transfer the securities to any other person, including a competitor. So it is important that when you raise money from investors, you understand that they also have the power to sell the company to your competitors if you do not give them an exit. Sometimes businesses mature or they are able to reach an inflection point at the 5th year or 7th year. But unfortunately, if you're not able to give an exit or the company is not progressing well, that could be the time you lose control over the company. So that is the presentation. Thanks so much for your patient hearing. I will stop presenting. I'll be happy to take any questions.
There is one question from Upasana Das in the chat box.
Okay, let me take, if an LLP wants to bring in new investment apart from founders, what is the way? See, you can bring in money into an LLP by introducing a new partner. But like I mentioned, there are complexities. So you cannot define capital tables easily in the LLP. So I would recommend you convert LLP to a private limited company.
Any other questions? You can unmute yourself and ask the question.
Yeah, hi. One last question from I'm Madhu here. Since we are going with LLP and PLC, all those things, so we are going with many kind of government regulatory forming, all those auditing, all those things. I'm being a technical architect. I don't know much about this, all those idea stuffs and all. So where can we get the proper right? Because in the market we can see hundreds of things. All are like if it applies, kind of, but we don't get any right suitable what is required for our case. How can we know?
Sorry, when you say right suitable for our case, what does that mean?
I mean, for example, let's assume I'm starting it. I started a one LLP. Just it's been, for example, 1 year. What are the things I must do? What is not required? Because probably I did a lot of things in the last 2 years, but later I got to know those are not required, kind of. So like this, we are simply wasting money and time both. So how can we know? I mean, any suggestion or something like that?
Which part of Karnataka are you located in?
I'm Shumoga.
Shimoga. Okay. Okay, see, maybe what I could do is I could find an advisor in and around Shimoga. Maybe you can go and talk to them and understand what needs to be done, because it's best you sit down with somebody who's been in the space, and have your questions answered. Now, to be honest, there is no set guideline which says do not do this or do this, right? Because
Okay, okay.
as long as these compliances are being taken care of, and there is in an LP, the compliances are extremely simple. Now, maybe you could also reach out to the Bangalore branch of ICI. Maybe the chairman could connect you with an advisor who could be of help to you, because LLPs do not have a lot of compliances.
Yeah,
Private companies have a lot more compliances. So please get in touch, maybe through Aishwarya with the Mangalore ICI branch. I'm sure they will have very good advisors. If not, I will also check in my network to see if we can find somebody in Shimoga.
that's really great. Thank you. Thank you very much.
I think we are done with the questions. Thank you so much, sir. It was an insightful presentation on understanding term sheets and investor agreements. We encourage you to utilize the knowledge gained today in this session and implement in your business and startups. Thank you once again, Mr. Pawan Sharma, for sharing this valuable expertise with us today. I would like to thank Gautam Pai for joining us today. Thank you, sir.
Thank you, Aishwarya. Pawan, thank you very much for the insightful and engaging session. You not just given us through all the must must know aspects of term sheets and the likes, but also clarified all the doubts of the participants. A big thank you on behalf of all the delegates who joined us this evening, and also on behalf of the Mangalore branch. A very big hearty thank you to you, Pawan, and your team.
Thanks so much, Gautam. Thanks a lot, Aishwarya. You all have a good
Uh,
evening.
Thank you. Bye bye.
I'll be sharing the feedback link in the chat box. Please fill it up. I
Sure.
hope you enjoyed the session. Until next time, happy innovating and best luck on your upcoming journeys. Thank you, everyone. Have a nice evening.